Umar here from Financial Wisdom. Recently, there has been a lot of talk regarding a federal interest rate hike or a cut. So today I've compiled a quick summary of the different ways that a federal interest rate hike would impact you, especially somebody in their 20s. There are many different types of lending, including mortgages, business loans, card loans, credit card loans, and they all get charged some type of an interest rate. However, the one that I'm talking about today, or the one that you hear the economists talking about on the news channel, is called a federal fund rate. This is the rate that the big banks charge each other on a short-term basis. If the federal interest rates stay too low for too long, then inflation could rise. Or on the flip side, if the interest rates are too high for too long, then the economy is impacted in the following ways. So the first way that a federal interest rate hike would impact the economy is through what's called creating expensive money, or being able to get access to cash a lot more difficult. If you're somebody in your 20s who's ready to start your own business, you're going to want to need some cash to be able to go ahead and secure a lease or buy some inventory. However, when you go to a bank, the bank is going to offer you a loan at a higher rate than normally what you would have gotten if there was no federal interest rate hike, or alternatively, if there was actually a federal interest rate cut. So for example, we'll take my friend Glamna. So if she's ready to open up her makeup business today, she needs to be able to buy some makeup related inventory so she can satisfy her customers. However, the problem is that she doesn't have access to cash right now. So she goes to a bank and the bank is willing to offer her that loan so she can acquire that inventory at a, let's say, 2% rate. If a federal interest rate hike goes into effect and she goes to the same bank 6 months down the road, now the bank is going to offer her that loan at, let's say, a 3% rate. That difference in 2 versus the 3% could be the make or break in deciding whether or not to go ahead and open this business. Side note, the reason that a bank would charge a higher interest rate after a federal interest rate hike has gone into effect is because, like I mentioned, the federal interest rate hike is the rate that the bank used overnight to charge each other on a short-term basis. So if a federal interest rate hike goes up, let's say now TD needs to borrow money from RBC, that borrowing of money from RBC gets more expensive for TD, and if Glamna goes to TD to borrow money from TD, TD needs to also make money on that loan, so they jack up the interest rate. That's just a little side note of why banks' borrowing rate goes up because of a federal interest rate hike. So the consequences of not being able to get that loan or not starting that business now because the borrowing rate is a lot more expensive is basically twofold. One is that there's a loss in job creation. So for example, if Glamna is not going to go ahead and open her own business, down the road maybe she was thinking of hiring other makeup assistants, other makeup artists in her own little company, but now she's not going to do that because she's not even going to start her own business because the borrowing of that money is so expensive. And the second is that there is an overall slowdown of the economies. So let's say, for example, if you're somebody who was going to tomorrow open a burger joint and you had a whole checklist of things you were going to go and buy, you would have contributed in the economy by going ahead and buying tube lights, paint, chairs, tables, machinery, all sorts of things to be able to get your shop up and running. You're not going to do any of that because, going back to step one, you don't even have the money to get going with all of that. So the impact of expensive money or a higher borrowing rate is that eventually there's a loss in job creation because corporations are not out there opening new locations, taking on more debt so they can invest in different facilities, invest in new endeavors. That leads to an overall loss in job creation, and secondly, slowdown in the economy. Number two way that a federal interest rate hike would impact the economy is through what's called creating a savers economy. In this scenario, people start to pile up cash in their savings accounts as the banks are not willing to offer a higher interest rate. The second implication of a federal interest rate hike is on your overall total portfolio strategy. So assuming that you have 80% of your return in the stock market, which is giving you an average of 5% return, however, a savings account is giving you, let's say, for the sake of this example, 7%, then you can maximize your return by reallocating funds between the two different classes. The overall implication of the saver economy is that people start to pile up cash in their savings accounts, and therefore the consumer spending goes down, which leads to a slowdown in the economy. Lastly, the federal fund rate hike would impact the housing market. Now this is because of, again, going back to the banks borrowing from each other on a short-term basis at a higher interest rate. In order for them to be able to make money off what they're borrowing from, let's say, RBC and giving it to TD, they need to be able to make money as well. So when they're offering you a mortgage of, let's say, $700,000, because they have potentially borrowed that money from a different bank to give you that money, they are now paying a higher interest rate, therefore they're going to charge you a higher interest rate. So basically the way it'll impact is, if you're somebody in a fixed rate, you won't see an impact on your mortgage payment of a higher federal fund rate. However, if you're somebody who has a variable interest rate on your mortgage payment, then you may see some increase of between $100 to, let's say, $500 per month depending on how big the mortgage is. So the bottom line is this: the government uses the federal interest rate to make sure inflation doesn't rise, consumer spending stays high, and unemployment doesn't increase. By managing these three things, the government can make sure that we don't start a chain reaction of things that ultimately lead an economy into a full-blown recession. So here's my opinion on whether or not a federal interest rate hike should happen this year. I think there should be a federal interest rate hike for two reasons. Number one reason is that we haven't seen the corporate level of debt that we're seeing right now since 2008. What that means is that with this availability of cheap money, corporations eventually start taking on risk and start investing in endeavors that don't necessarily align with the corporate strategy. For example, take Baytex in 2015 when the oil prices were at their highest, interest rate was practically zero in Canada, so they took on a $4 billion debt to acquire some oil assets. We all know what happened in 2015. The oil prices tanked, and since then Baytex has lost close to 60 to 70% of its stock value. So relying so much on having everything play out in your favor just so then you can repay the debt is a very scary thing, and going down that path eventually leads to corporations losing a lot of value, making a lot of poor decisions, and ultimately losing value for its shareholders. Number two reason is I think the housing market is still very hot. There has been some cool down in the last year and a half, but since 2008 we've seen the level of returns that we haven't seen in this housing market, and what that's done is it's created somewhat of an investment property phenomenon. It's essentially created a whole new industry of buying and flipping houses to a level we haven't seen. What I think is that in order for young adults to be able to get ownership of land and be able to start raising their families in their own homes and eliminate this whole concept of investment properties, we still have some room to go where we can start to price out the people that are buying. They already have their first property, but now they're buying their second and third and jacking up the prices. We have some room to increase the overall interest rate there in terms of being able to help out the young adults so that they can get priced in and eventually cool down the demand of the housing market so they can buy at a reasonable price. This is it for this week. I briefly mentioned about Baytex in this video. Overall, I'll have my thoughts on whether or not oil and gas, where it's headed. We had a really good start to the year in oil and gas. However, recently it's starting to tank. So I'll have my thoughts and opinions on that in the next episode, and which are the oil companies that I'm looking at, whether or not if I should be looking at those oil and gas companies. So this is it. Goodbye.